Well, welcome to the Genus video. It's the end of January 2019. The fourth quarter of 2018 was an exciting one. Wayne, last video we talked about us being in the end of the business cycle, approaching the end of the business cycle. What did the bad markets, down about 10% in the fourth quarter, mean for where we are in the business cycle?
Actually, I think they may extend the business cycle. Yeah, I think it helped crush some of the inflation expectations and put a lid on rates. The Fed's effectively done. That's a good thing. And we could end up with a soft landing here globally and go on for a couple more years.
The mood definitely has improved. We're fast out of the gate in January so far. So Wayne, one question I have that I don't hear a lot of financial people talking about, which is, I think, going to be a big issue when we do have a recession, even if that's 2 years from now or 3 years from now, is the debt levels are really growing. They're high. GDP, government, corporate, household. I know interest rates are the main thing short term, but this accumulation of debt, isn't it an issue?
It's an issue. In the longer term, it's an issue, obviously. If we had stronger GDP growth, that would definitely help mitigate that, because growth can get you out of these kind of problems. It's also the reason why I think we've seen rates peak here short term, and why the Fed's probably done for the coming year, because the economy and the markets can't take higher interest rates. So it's helping put a lid on rates, I would say. But still, it's a longer term issue we have to deal with. And the only way to get out of this issue is by growing out of it, I believe.
Right, or some would say, inflating our way out, but that will be for later.
Yeah.
Just to segue into the actual portfolios, between the spring and the summer, we basically sold growth stocks, bought defensive stocks, and bought for the first time since 2008 some government bonds. Tell us about the yield on bonds and why we're finally owning some.
Well, just from the previous question, the point you made there, that the economy is sensitive to higher interest rates, and so we think over the next 6 months to maybe a year, we have a lid on rates, and at least you'll get a yield off this. Stock markets will be volatile. Not a bad place to park some more money. We find the U.S. bonds more attractive than Canadian bonds. Obviously, they're yielding much higher, but we think you'll get at least your carry here on bonds through the course of the coming year.
I always like to ask you impossible questions just to see what you say, but the problems we're having with the Chinese government and the Saudi Arabia government, we're not exactly endearing ourselves to big economies around the world. I'm not saying whether that's good or bad, but what is that effect, or is there an effect? What do you think on our economy?
Well, I think that's the big question mark about the global economy, is the China-U.S. trade relationship. I think right now they're probably both motivated to get a deal done. Economy's slowing faster than expected in China, and Trump wants to get elected in 2020. So I think there's going to be a deal done this year, crossing fingers, of course. But I think they're both motivated. It makes sense to do something. And I think...
But what about Canada? And maybe it's something that the market doesn't care about, but China doesn't like us.
Yeah, I don't know what Canada can do about China. Canada has no leverage when it comes to China. And it's
not a positive.
It's not a positive. We have no leverage at all with them.
Right. So we talked about how last spring we sold, or summer even, we sold growth stocks, bought defensive stocks, bought government bonds, and we're still in that posture. We're still not getting back in the market. We're still defensive. The signals are still negative.
Well, I think for the coming year, the markets will probably be range bound. The S&P will probably trade between 2,300 and probably 2,900. We're in the middle of that range right now, so more volatility, typical of end of late cycle behavior. As rates have gone up, you'll see more volatility, more uncertainties. But I think we're hopeful longer term that this bit of a slowdown is going to actually keep inflation under control. That's a good thing.
Right. And
so what's been hurting our models, or driving our models to be more negative, has been higher inflation fears and tight money. So with the Fed being on hold, inflation being less of a problem, those things can swing over the course of the next year and maybe push our signals to more of a positive tenor.
Great. Wayne, I want you to just refresh our memory on the valuations of the stock market. Is it cheap? Is it expensive? And why?
Well, right now, the valuations have really improved over the course of this past 6 months. Earnings have gone up and markets have gone sideways to down. So that's helping. Actually, Europe looks really cheap. We don't see any reason to get in there yet, though. Canada looks pretty good, and U.S. is still in, I'd say, fair valuation. I think that going forward with all the uncertainties, though, and the cycle getting older and older, what's going to drive the market higher will be growth in earnings.
Right.
I don't think valuation is going to improve anymore, but I think earnings have to drive things, and they still can grow 5 to 7% next year in the U.S. And if we can get a global resurgence over the next year or two, that can push earnings higher too.
Right. So really, we're not negative. We think what we saw was a late cycle volatility. It wasn't the end of the cycle.
Exactly.
We don't think we're entering the end of the cycle, but there will be lots of volatility. So Wayne, we continue to have global political risk, just to mention a couple of things: the trade war, the shutdown, Brexit, the yellow vests in France. Do you expect this is going to continue, n'est-ce pas?
It's going to continue. I think this issue of the middle class wanting more, a bigger piece of the pie, is not going to go away. And it's going to impact politics even further in the coming years. I think Brexit just is case in point there, where people have been left behind and they want more. But I think for Brexit, I don't know where it's going to go, but it probably will get kicked down the road, delayed for maybe a year or two for all we know. We don't foresee a hard Brexit, but it could happen. But I think it'll just get pushed down the road. But still, it's a problem that's happening across all of Europe, with the Yellow Jackets, for example, and it's an issue in the U.S. too. So I think it's an issue between people in the middle class, wanting more earnings growth, and
it's not there.
Yeah.
Even though we have great employment, the wage growth isn't there. I read in the Globe and Mail this morning an article about 50% of all Canadians are $200 away from insolvency. And those 50% have just as many votes as the other 50%. So this is not a problem that's global, but not in Canada. This is a Canadian problem.
It's happening everywhere. And it was all started with the Great Recession of 2008. People just haven't, a lot of the middle class haven't caught up from that. And there's been winners and losers. And
few big winners.
Yeah.
Right. Well, thank you for listening today. Please call us if you have any questions. We love to hear from you, love any feedback, and we'll see you next time.